Hi, today I will be talking about Hallenstein Glasson Holdings Limited. So, who are Hallenstein Glasson Holdings? This company consists of 7 total subsidiaries, 4 of which are trading companies. These are Hallenstein Bros Limited, Hallenstein Brothers Australia Limited, Glassons Limited, and Glasson Australia Limited. They own 2 non-trading companies, Retail 161 Limited and Retail 161 Australia Limited. They also own a company for the purpose of property ownership in New Zealand. This is called Hallenstein Properties Limited. All subsidiaries are owned and controlled 100% by the Hallenstein Glasson Holdings. The primary activity of the company and its trading subsidiaries is the retail of men's and women's wear throughout New Zealand and Australia. Across the group, they have 116 stores currently operating, with the majority of them in New Zealand. As they are listed on the New Zealand Stock Exchange, Hallenstein Glasson Holdings are required to have an external auditor, in this case, PricewaterhouseCoopers, also known as PwC, who perform an audit of the company every year. This is required by law under the Companies Act 1993, the Financial Markets Conduct Act 2013, and the Financial Reporting Act 2013. Performing an audit also comes with many other benefits to investors and other related stakeholders, such as management, government, lenders, customers, and employees. Auditing can help identify material misstatements within the financial statements, as well as highlighting matters of interest. Auditing increases stakeholder confidence in the accuracy and reliability of the information within the statements. Now to look at the inherent risks of the company. According to ISA NZ 200, inherent risk is the possibility that a material misstatement is made in relation to an assertion due to factors other than the failure of internal controls. This type of risk exists independently of the audit of the financial statements and cannot be changed by auditors. For Hallenstein Glasson, this includes the following: COVID-19 and the state of the market and the economy. As a result of the worldwide coronavirus pandemic, many businesses have been hit hard financially as countries have been placed under lockdown. This has had a hugely negative effect on the economy, forcing New Zealand into its first recession in 11 years. Recessions often come with consumer fear and uncertainty, with many becoming more cautious in their spending habits. For Hallenstein Glasson, this is likely to have an enormous impact on their operations and revenue stream, as online sales account for 15.2% of the group turnover, meaning that the other majority, 84.8%, normally comes in the form of walk-in customer sales in physical stores, which has not been possible. And this is in addition to the likely drop in sales caused by the uncertain state of the economy. A poor economic state or market uncertainty may cause management to try and manipulate financial statement numbers so that they look better than they actually are. Auditors need to be aware of more aggressive earnings management that may cross the line and in fact be fraudulent financial reporting. To mitigate this risk, auditors should engage in more thorough communication with management and pay more attention to the company earnings. With 116 stores across New Zealand and Australia, Hallenstein Brothers and Glasson stores are susceptible to theft of inventory and cash from employees, as retail workers are often paid low entry-level wages and work as casual staff. For the auditors, this can mean missing numbers and incorrect inventory stock takes. To mitigate this, they need to communicate with managers and those that monitor inventory systems to ensure that numbers are accurate. As the Hallenstein Glasson Group has subsidiaries that operate overseas, they have an inherent risk involving the translation of foreign currency. This is the Australian dollar to the New Zealand dollar, which is the currency they report in. As a result, auditors will need to pay extra attention to the procedure in which the group's financial statements have been consolidated, as foreign exchange can often be very complicated. Have they used the correct exchange rate for the correct period? Are foreign currency reserves complete? That sort of thing. Moving on to control risk. Control risk is the risk that a material misstatement could occur in an assertion without prevention, detection, or correction in a timely manner by the company's internal control structure. Retail sales can often involve large sums of cash. With this comes the risk of employees incorrectly recording the sale and its amount, or simply handing over the wrong change to the customer. This is most likely to happen due to improper training and experience. As a result, the auditors may want to investigate the company training procedure to ensure that it is sufficient and robust. As a retailer of clothing and accessories, Hallenstein Glasson have a very large amount of inventory on hand, and it is important that they have the proper systems in place to manage this inventory so that their sales are not impacted due to incorrect inventory on hand, either too little or perhaps too much, making it difficult to sell before the next line of clothing arrives. Auditors will need to look at the assertions involved with inventory and ensure its completeness, that all inventory has been properly recorded, and that all stated inventory exists. Due to the large nature of inventory and its significance to the company and its operations, there may be issues with the valuation of inventory. Management may be using unsuitable procedures to value inventory, resulting in greatly under or overvalued assets. Auditors will need to investigate management assertions of accuracy, valuation, and presentation regarding inventory. Looking at these risks individually, we can class them as low, medium, or high. COVID-19 is likely to be of high risk because of the impact on brick-and-mortar stores, as well as the uncertainty it brings with it. The risk of theft is low, as many stores in this day and age have security cameras as well as systems to monitor activity. Foreign currency exchange is moderate, as the exchange rate is always fluctuating and foreign currency translation can be very complex, increasing the chance of error. Cash point of sale risk is low, as many sales systems make it difficult to mistake cash amounts, as well as automatically calculating the change for the employee. Inventory management risk is low because large retailers such as Hallenstein Glasson have systems that monitor inventory levels and place orders when necessary without the need of human input. Inventory valuation risk is moderate. For this presentation, the item I've decided to audit is inventory. This is an essential balance sheet item to the company as it is the primary source of revenue generation. Looking at the balance sheet, we can see that inventory makes up 49% of current assets and 23% of total assets, showing just how important it really is, with a balance of more than $24 million. Inventory turnover is 76 days. This is better than the local Kiwi brand Kathmandu, who also retail clothing and outdoor equipment. They have a turnover of 210 days. Audit procedure approach. There are two different types of approaches to the audit strategy that one could take. The first being for a company of lower control risk. This is the lower level of control risk approach, and the other for a higher level of control risk, called the substantive approach. As I've classed the control risks as medium to low, I would take a lower level control risk approach to the audit of inventory, although substantive procedures such as test of balances are still likely to be performed. Because of the lower risk, we are able to rely more on the controls of the company, which will reduce the cost of the audit. The first procedure that would be performed is recalculation. This involves checking the mathematical accuracy of records, documents, and inventory valuation. An example of this would be recalculating the weighted average cost and comparing it to the purchase invoices, or comparing the net realizable value of inventory lines to selling prices. The second procedure would be performed as observation. This is the process of watching the performance of some activities or processes. For example, the auditor may choose to watch the performance of a stock take within a sample of stores across New Zealand and Australia to ensure that the correct activities are carried out, as well as ensuring the physical presence of the inventory is correct. To conclude, Hallenstein Glasson Holdings Limited is New Zealand's largest clothing retailer, selling items for both men and women. Following the discussion of three inherent risks of the company, these being COVID-19, theft, and foreign currency exchange, as well as three control risks, cash sales, inventory management, and inventory valuation, I've concluded that the audit risk and the risk of material misstatement is moderate. The item I decided to audit was inventory, as this is an essential part to the operation of the company. I found that due to the level of control risk, a lower assessed level of control risk approach was appropriate for the audit of this item. Using both recalculation and observation audit procedures, I'm confident that the potential material misstatements and incorrect assertions will be caught. Thank you.